inflation, of course, in focus. Tomorrow, the Federal Reserve begins the first two-day meeting of the year. This is the first Fed meeting of 2022. We are anticipating at least 4 rate hikes this year. Goldman Sachs out now saying inflation will cause more than 4 rate hikes. But there's also a debate underway about how markets will react and whether or not market disruption will stop the Fed in its tracks from raising rates. Joining me right now is Cornerstone Macro co-founder and partner Nancy Lazar. Also joining the conversation all morning long this morning is Dagan McDowell and Michael Lee. Nancy, it's great to see you. Thanks very much for being here. I want to get your take on what's behind this major sell-off of the new year. What do you think?
Well, I've been pretty optimistic on the U.S. economy for the past couple of years, but as we started 2022, there really are 3 major headwinds to global growth in particular, but also incrementally in the United States. First, everyone's talking about the Fed. Absolutely, what the Fed does is important, but we've already been in a global tightening cycle now for a year. There have been 95 global central bank tightening moves, mainly led by the EM world. My point is that was already going to be a restraint on global growth here in 2022, and now the Fed risks obviously adding to that, further increasing the odds we see a slowdown not only this year, but potentially into 2023. So I think one of the reasons the markets are reacting so negatively to the Fed, it's not just that the Fed is going to move, it's on top of what has already been a very, very clear global tightening cycle. Second, oil was already a headwind on global growth here in 2022, not so much to the United States for obvious reasons, but certainly to Europe and some of the other emerging economies. And indeed, if we now see oil prices go even higher because of Putin, at the end of the day, that will further aggravate, obviously, the global slowdown that we already see in the cards. And then third, it's becoming very, very clear by company announcements that this stay-at-home spending trade is over. You have excessive inventories, you risk seeing production cuts, and you're going to therefore see weaker earnings. And so very, very different backdrop than what I've seen over the past couple of years. Fundamentally, I still think the United States is the strongest economy in the world. But at the end of the day, a significant global slowdown with a risk of a global recession if you do see Putin moves indeed increase oil even further, and if the Fed does get too aggressive. I would agree that I don't think the Fed can get too aggressive given this global backdrop.
Yeah, great analysis, Nancy, as always. And I've got one of your reports in front of me back from January 17th, where you say the Fed and oil risk creating a 2023 global recession. Yep. Where are you on the rate hikes? Because the CEO of the Lindsay Group, Larry Lindsay, was with me last week, and he basically said, sure, the Fed wants to raise rates 4 times, but will it be able to, given the market's disruption? Here's Larry Lindsay from last week. Watch this. Got to get your reaction.
I think the Fed is going to probably increase rates 4 times this year, starting in March. It'll be interesting to see if they start their quantitative tightening, where they actually start to sell off their assets. But the market is going to react strongly at some point. And I don't think the Fed will, once that happens, continue to push forward. I think they'll take a pause. Say a 20% drop, something like that. I think the Fed will pause.
So what do you think, Nancy? Is the markets ready for what's coming at them? And will they be so disrupted that the Federal Reserve will have to stop in the middle of its plan in raising rates?
Well, so first, my colleague Roberto Perli doesn't necessarily believe they are going to go 4 times. He would think maybe 3. And if our inflation forecast is right, the Fed doesn't need to go 4 times. I think inflation is going to slow significantly because of what I mentioned on the consumer side. Look at what Lululemon is doing. They are now discounting more and more products. And so we think within the consumer space, there's actually going to be deflation. To be sure, we're already getting this financial market turmoil. And ask why. It's not in anticipation of the Fed. It's because you already have these leading indicators pulling down global growth. The EM tightening cycle, the surge in the price of oil over the past 2 years are already headwinds to growth. And I think inflation slows significantly. This reminds me, if anything, a little bit like 2011, when Trichet saw inflation in the Eurozone move up to 3%, above their target, and they tightened in an environment that the economy was very fragile, obviously the peripheral crisis, and they just made it obviously even worse. So I would agree that if the Fed steps in and tightens aggressively, yes, it's going to make this global backdrop even worse and does risk a global recession for 2023. And U.S. growth would be weaker than I would otherwise think. But again, we don't think the fundamentals support a aggressive Fed here, because this inflation pull forward was due to all that stimulus that was put in place. It's now gone. You squeeze that low-end consumer. They no longer have excess cash. The stimulus payments are obviously done, and inflation in the fourth quarter ate it up. And so real consumer purchasing power is getting squeezed at a time in which companies have too many inventories, production is going to end up being cut, and you will see, we would argue, deflation. So, no, I don't think the Fed needs to be aggressive, but certainly the fear of that is continuing to roil the markets. But again, I just have to repeat, the community is ignoring the global backdrop. We are a global economy. Many companies are globally based, and the tightening cycle was already set to slow the economy here in 2023, and the Fed would obviously make it worse, but so would Russia, big time. And that's why we've raised the specter for the first time of a global recession, possibly in 2023. I hope not, but it is what it is.
But Nancy, you know, you were very positive on the consumer earlier in 2021. You saw all the stimulus coming at them. Demand was on fire mid-year, end of year, but that's all gone. They've spent that money, and I'm hearing that the supply side of the economy is a disaster, that the chip shortage worsened at the end of last year. So you've got a demand question, and now you've got a supply problem. What's your take there?
Well, we think the supply side of the economy is actually already starting to ease pretty significantly. You've started to see auto production slowly pick up. I don't think they want to increase it aggressively. The consumer doesn't have the firepower to buy a lot of new cars here in 2022. So exactly, I think 2022 in many instances is the opposite of what we saw in 2021. The stimulus is gone. Prices have eaten into consumer real purchasing power. That wasn't the case a year ago, but when the facts change. And so you must really look at the economy very, very, very differently. But I think the supply chain problem, our imports are up significantly. There's still a lot of boats in LA Long Beach ports, but they're offloading those boats. And so we think, if anything, there's going to be involuntary inventory accumulation. This to us reminds us of Y2K, which many of your viewers probably don't remember. I certainly do. And that did end in tears. And I think that is a real risk today for many of these consumer companies.
Yeah, I remember Y2K. We were all waiting to see that the clocks would break because you were going to the year 2000. And then one by one, every country, nothing happened. It was one big expectation, and it was a total non-event. Nancy, great to talk with you as always. Phenomenal analysis as always, Nancy. We'll see you soon. Thank you.